So lately, I've been trying to study more public companies to invest out of my personal account. I use what's known as a fundamental investing philosophy, meaning I'll study the company's business model, I'll try to understand its unit economics, and sort of try to build a simple valuation for the business. And I think this is a really important skill if you're preparing for hedge fund or private equity or even investment banking interviews. At some point, you're going to have to be comfortable understanding and studying a public stock. So there's obviously a lot of different things you can do, but in this video, we're going to cover some of the basics, meaning how to collect all the proper information and how to really try to study a company's business model. In this video, we're going to be partnering with a Canadian small cap company called Kits, which is a digital eyewear retailer. They trade under the ticker KTYCF in the US as well as under Kits on the TSX. I also want to give a quick disclosure that I do own stock in Kits. So I did research on this business, I decided it was a good investment, and I did purchase some stock. So a couple of months ago, I actually received a free pair of glasses from Kits as part of a promotion. And I remember being intrigued by that because it kind of means that this company is so confident in its product and in its sales cycle that they can literally give away free material. And when I looked into the business, I realized that Kits is a digital to consumer brand, and they've been growing at a very rapid pace, essentially increasing their revenue on a quarter-over-quarter basis. Now, why this is important, especially at the small cap level, is a lot of these businesses will trade on revenue, specifically revenue growth. I think it's a key insight that you get when you study technology businesses. But a lot of the valuations of these fast-growing businesses is almost entirely predicated on the revenue growth and the revenue multiple that you get. The principle here is that we're very focused on future earnings and the future cash flows that you can generate. And so revenue growth is extremely important, and that's something that Kits does very well. I've actually followed the digital eyewear space for quite a while. I was pretty interested in Warby Parker as a business. I used Luxottica as my stock pitch way back when I was doing my private equity interviews. And I think overall, it's just a very interesting space that's ripe for disruption. Only 13% of all eyewear retail is done digitally, which I think represents just a big opportunity. The North American eyewear market is $35 billion and contact lenses are $7 billion annually. And if you think about Kits as a business, they had 80 million in run rate revenue, and that's Canadian dollars. So they definitely have a long runway to go, even if they're just taking share from other businesses. So before we dive any deeper, it's actually really important we do the tactical step of research. Now, what does that mean? It means we need to collect all of the necessary filings that are available. So what kinds of things are we looking for? At a very minimum, we'll want to take a look at the last annual report. If it's a US-based company, that means they'll have a 10K. We want to look at their investor presentation. This is the company's narrative about itself. And finally, I would just do a quick Google search, look for any news articles, look at what their competitors are saying, look at what kind of the overall narrative is about the company. So what I like to do is save all these files down into a specific folder. When you go into banking, this is going to be called a public information book. So this is just a preview of that work deliverable. So now that we have all of that information collected, the next thing we want to do is understand the company's business model. So what does this mean? It means we want to get to a point where we can elegantly describe how a business makes money in one or two sentences. You want to think about things like, what do they sell? Who are their customers? Who are their competitors? Who do they buy from? All of these functions that kind of comprise the day-to-day operations of the business. So let's practice with Kits, and honestly, a very easy place to do this, if you just Google and go to the About Us section of a company's website, they'll probably have tried to do this for you already. But Kits is a direct-to-consumer digital eyewear retailer that sells contact lenses, glasses, and sunglasses. They operate their own line of Kits design products. Now, Kits has several online tools which optimize the shopping experience, which include online fitting tools, virtual try-on for glasses, and online vision tests. And that definitely doesn't cover everything about the business, but it gives you a high-level kind of tagline for what they do, and you can walk away knowing that it's a digital retailer of eyewear. Kits also owns a factory in Vancouver that can produce 4,000 glasses per day, and that allows them to ship products the same day that you order them. When you contrast that to very traditional glasses retailers, oftentimes it can take 2 to 4 weeks, so it definitely has this kind of Amazon Prime element of delivery to it. So in terms of Kits' products, they primarily actually sell contact lenses. The majority of their revenue comes from contact lenses currently, which are a very good subscription-based product. And then of course they resell products from other luxury brands like Ray-Ban, other brands from Luxottica. Now the very next important thing we have to do is understand the unit economics. Now, what does this mean? It's essentially asking on a per sale or per customer level, how much money does the company generate? And the principle here is that if a company is not profitable at the unit level, there's no way it's going to be profitable at the company level. There's two very important concepts we're going to borrow from software, but it really applies to a lot of subscription businesses, and that is the lifetime customer value as well as the customer acquisition cost. We want to look at a customer's lifetime value. This is all of the money that a customer is going to generate over their entire life for this business. So if you take Starbucks, for example, a devoted Starbucks customer that gets coffee every single workday, you can calculate how much money that Starbucks is going to earn off of that consumer. It's going to be gross profit times number of coffees over their entire life. And we can apply that principle to pretty much any business. So for a company like Kits, we could approximate this by looking at how much eyewear an average customer is going to buy over their entire life, then apply the gross margin to get to kind of an estimate for lifetime value. And that is going to inform what a company is willing to spend on as their customer acquisition costs. And that's why I think the promotional model of Kits is so interesting. They're willing to spend $40 on kind of brand new glasses and send them directly to the consumer in order to win them. Because if you compare their lifetime value to that $40 customer acquisition cost, you'll see that it's worth it. Now, this is from their investor presentation, but Kits essentially estimates that the average customer is going to generate $600 over their entire life. And this would already account for factors like churn as well as average order value. So what we essentially would do is divide $600, that's how much they'll receive from us, and divide that by $40 acquisition cost. And that gets us to 15 times LTV over CAC, which is pretty high. That's, I would say, extremely high. And you might be wondering, how could this LTV be so high? How is it $600? Well, that's because of this concept of subscription. And that's why subscription businesses are so great. Because especially for contacts, you're going to be buying contacts every single month from the same supplier, provided that they're pretty good. Kits had roughly 70% repeat customer revenue, which is extremely high for consumer business. So if they can keep this up, it's no surprise why their lifetime value would be so high. And finally, let's close by talking about some of Kits' financials. So I would actually say Kits surprisingly has pretty strong financials. They were free cash flow positive in 2020. Free cash flow, of course, is how much cash flow a business is generating after all of its main outlays. And being free cash flow positive, I think, is really impressive at this stage. It shows that they do have the opportunity to have strong cost controls and that their unit economics actually work. It took Warby Parker, for example, several years to ever get to that point of profitability, and I don't think they're putting up the margin numbers that Kits is. And I think part of this is because they don't have any physical locations, so that's a very big boost to EBITDA. But additionally, the corporate managers of Kits have experience in this space. The CEO, Roger Hardy, previously sold Clearly Contacts for over $400 million, and I think that is just a good proof point that they understand how the space works and what it takes to run a profitable business. So Kits has about $80 million in run rate revenue, and what run rate essentially means is that we're taking just a short period of time and extrapolating that for an entire year. Now, it's really important for these small cap kind of growth companies. Again, we're very focused on revenue growth, and we almost always want to think about future revenue because many of these small cap businesses, they essentially are being estimated to grow into a certain amount of value. So there's one last thing I want to say about valuation. The company's overall market cap is about $250 million. The run rate revenue is $80 million, and that kind of implies almost a forward 3 times revenue. In contrast, Warby Parker has been valued at $3 billion. They have an estimated forward revenue of about $600 million, which means they have a multiple of 5 times. In my mind, Warby Parker and Kits almost have an identical business model. So you would expect a faster growing, purely digital version of that business to theoretically trade at a higher multiple, or at least with a closer range. There aren't a lot of great pure play digital comps. The overall retail comp set, which is not perfect because it tends to have more physical retailers, trades at 3.5 times. So you would honestly expect a high growth digital business to trade in excess of that. Luxottica, which is, of course, the biggest business in the space, trades closer to 4 times. One other detail, and I think a big potential catalyst, is that this business is not very well covered by equity research. Canaccord Genuity is the only equity research firm I saw that has a price target, and it has a target of $17, which is over double where it currently trades. And I think that's a potential catalyst. Once other equity research firms start covering this business, you'll see likely more share price appreciation. So that's it for this video. If you like this kind of content and you want me to cover more public companies, feel free to let me know and I'd be happy to look at more similar businesses. I'm only going to be focused on companies that I think actually present good opportunities. I think Kits is one of them. It's one of the only ways to invest in D2C digital eyewear, and I think there's a lot of runway for the business. So I hope this was a helpful case study of a public company. If you're interested in learning related skills like how to build a DCF and how to study a public company thoroughly, then you can check out our Valuation Finance Starter Kit on our website. Thanks for watching, and I'll see you in the next video.